Hello again, everyone. Thank you for joining us for our sixth outing as Future of Money. It's great to see you all here, and also welcome to everyone that is joining us live on YouTube. As you're all aware, our topic this week is Africa leading innovation in fintech. And luckily, we've managed to bring together two fantastic speakers.
Hey,
I'm hoping we'll be able to give you a brilliant insight on the topic, and it's something that's developing, as we speak. So you've met them both before. It's Ollie Walsh and Santiago Velez. And this is a topic that we've been planning to cover for quite a while, actually, because it's something that came up really early in our discussions when we were talking about the future of money, because it's something where, we've been seeing for a long time innovations in Africa that have then been feeding through actually into our world here in the UK. So things like M-Pesa, for example, and mobile payments started a long time before what became commonplace here. So it's really interesting to look at how Africa could keep pushing that forwards and perhaps see even greater innovations that we're not even anticipating here. So Ollie is CEO of Pipit Global, a fintech startup who facilitate international payments through their digital cash collection platform. And Santiago, as well as being a former nuclear engineer, is a recognized commentator and influencer on digital and cryptocurrencies, and is research and development lead at Block Digital Corporation. But not only do we have Ollie and Santiago, we're also joined by our guest host, Alex. So welcome, Alex. Thanks for joining the team. Perhaps you'd like to tell everyone a little bit about yourself.
So my name is Alex as you said, Nyamoya Boyi. I'm Burundian. I've been living in France for almost 13 years, and have background in hospitality and tourism, as well as in finance. A bit different, but it will make sense in the future. And this summer I started a company, a consulting firm that works in an intersection of sports and tourism. I am also a host of two podcasts. One is Parole, and it really brings different voices of African leaders who wants to change the narrative and doing really amazing things on the continent. And obviously involve foreigners, let's just say that, who want to invest in Africa as well and want to hear something else, something new, something fresh. Africa is full of leaders and it's full of youth as well. And I have another podcast about sports. It's Sports Women, how to talk about, change makers, leaders of tomorrow, how to change the narrative of women athletes in general. So that's that.
That's brilliant. So thanks, Alex. So let's get into the questions then. Ollie, we'll start with you. Tell us about Pipit Global. What makes you different from other companies that are out there?
So Pipit Global, as you said, facilitates international cash transactions. So the gap we saw in the market is when somebody moves country, it's very difficult to get a bank account open, and therefore they're remitting cash home, which is very expensive. As you know, there's a glut of new digital platforms for remittance. We're competing on cost and speed, basically, but they all start with the assumption that the consumer has a bank account or some way to get money into the system. Mm-hmm. We saw a big gap there that people don't have the ability to get funds in because they don't have a bank account. So what we've created is a digital cash platform. So at one end of the platform, we connect to banks, e-wallets, billers and e-commerce providers. And at the other end, we connect to cash collection networks. So our customer, our merchant is always the B2B provider, and the ultimate consumer is usually a migrant, so supporting their families at home. So the model is, instead of remitting cash to pay a bill, you can log onto a platform, select that you want to pay a particular bill in Kenya, and then go to the post office and pay that in cash rather than sending the money home. So it's about 70% cheaper than sending the money home. And the sender also retains control of the funds, because when you send cash home, it can be misspent. And there's also a security element that nobody's collecting the cash. So that's essentially what we do.
Mm-hmm. All right. So Ollie, I myself being a part of the diaspora here in France, I know how much it's difficult, honestly, to send, how expensive it is to spend the money abroad. How do you gain the trust from us, the diaspora? And how do you make sure that on the other side of the continent, you have to do with the security, and how do we trust you guys when you Pipit is operating in Lagos, and the country's Lagos, Nigeria, is known for cyber fraud. Like, how do you deal with two things?
So that's why we became a B2B company, really. When we started off, we had the idea was to create a consumer brand, and we very quickly realized that the road to building enough trust to build a consumer brand was a long and expensive one. So we pivoted to be a B2B provider. So we connect with merchants. So for example, one of our merchants is Sterling Bank in Nigeria. So as opposed to Pipit telling the consumer you can now use this cash service, it's Sterling Bank telling their existing customers, who, and trust goes both ways, of course. So these are customers of the bank, but the bank has also onboarded them, completed the KYC, the anti-money laundering, and all those onboarding requirements. So you're not trusting Pipit to with your money, you're trusting your own bank.
So Santiago, when you think of fintech and innovation in Africa, what comes to mind straight away for you? And then kind of following on from what Ollie's just said, how could innovations in cryptocurrencies there mean that trust and confidence could grow in the systems in Africa?
I think primarily there's an opportunity for leapfrogging, where the adoption that occurs doesn't go about the traditional life cycle of adoption in, say, the West. And you get to the point where, mobile payments and e-payments are the predominant form of remitting money and transacting, rather than going through the financial institution and having to rely on kind of this maturation of their local financial markets. So it's really an opportunity I see for the continent to embrace the technology and not have to kind of repeat some of the mistakes that have been made in the past that create systemic risk. So digital assets were constructed precisely to address some of the problems around counterparty risks that banks represent, and that more systemically nation states may represent with their monetary policies. So it's kind of a unique window of opportunity for people that normally would not have had access, that even through mobile can get to this next level of technology. So very encouraging.
All right. So for me, I still have those African questions, I guess. If it is not trust, it's about energy. Blockchain, we do know that it takes a lot of energy, and we do lack some countries really do lack infrastructure about that. How can we say, like, we still trust you guys, we still trust the system, and how can it be implemented in particularly on the continent?
This question is for me?
Yeah, yes.
Yeah, so there are a wide range of basically consensus systems, that's what they're called, but they're basically, so blockchain technology at its root level is designed to preclude what they call a double spend. It's where you can have accurate accounting in a network of participants without having to worry about using a third-party intermediary to account for everything and be an agent of trust, right? So if I were to send you, Alex, a payment, I'm relying on a third-party facilitator to be that agent of trust to make sure that you receive the payment and that there's accurate accounting all across the board. And that, more importantly, I can't go and send it again to George and do what's called a double spend. So a blockchain, that technology, that word, is really just one type of consensus algorithm, which allows people to transact with code and not worry about a double spend. So it's the code itself that ensures that trustlessness, right? That those transactions will occur and settle. Now, some blockchains, the way they arrive at consensus, an agreement as to who has the value. So if I send it to Alex and not George, everyone on the network has to agree to that. There are systems that use a process called proof of work, which is a very computationally intensive process and therefore consumes a significant amount of electricity to be able to essentially arrive at this settlement and avoid the double spend. Now, that's only one of many different kind of designs that exist. And there are some new and more efficient types of consensus algorithms that allow you to do the same thing and avoid the double spend without this massive energy effort. Now, that being said, energy being a kind of a basic infrastructure for any nation state and making sure their citizenry has access to, say, the internet. I mean, at the end of the day, you need a way to power your devices and your networks, mobile networks. So the energy infrastructure is critical, but there's one very interesting and key distinction with blockchain is that it's a wallet-based system. It's not an account-based system. And what this means is that if the power goes out and the electricity at your bank goes down and the computers aren't functioning, you can't withdraw your money, right? There's really no way to withdraw your money. And there's no way to prove that your money is there at that given moment. Now, with a blockchain, if what happens is locally the grid goes down for a brownout or something, your funds are in a wallet that is kind of virtualized on the internet. So if the power goes down locally, you don't have to worry about your funds not being lost, right? So there's kind of a couple of, it's a multi-layered answer in that first, there are blockchain and distributed ledger technologies that are much more energy efficient. And then secondly, that the infrastructure that a nation state depends on to facilitate transactions can be ameliorated by having a global network that's not dependent on the local geographic resource. So I hope that answered the question.
Yes, absolutely.
From our end, but I mean, that is also a reason to avoid the cashless economy. That's, as we've seen with various banking going out and Visa across Europe going out for a day or two. It happens frequently enough. I know my own bank in Ireland here, their systems went down for 3 or 4 days last year, and you had no access to your money at all. So there is a big push for a cashless economy, and that is one of the reasons to keep some cash local.
Yeah, I think there's definitely big questions probably around the practicalities of whether it's really possible. I mean, do you think, Ollie, that it's perhaps all too much too soon? Is it we've been saying before, and we've spoke that if the whole idea of your company is that you can directly pay for things when you're sending money back home instead of it going through perhaps a traditional money transfer company. So if you're still paying your grandma's energy bill through your company, how can we expect grandma to suddenly start using a digital or a cryptocurrency? Do you see the developments now as a solution to banking the unbanked, or is there still quite a long way to go in that?
Well, there's layers within that question, George, because I mean, there's early adopters who in a classic market who will get in early. It could be very possible for me to pay grandma's bill through blockchain without grandma having to know anything about it.
Yeah.
Through directly to the provider. For us, it is about the unbanked. It's about when you move country and you just cannot get a bank account, and usually for ID reasons or bureaucratic reasons. But in some parts of the world, the UAE, for example, you need to have a specific work visa before you can have a bank account. And if you work in hospitality, for example, you can't have that. So all hospitality workers are all paid in cash, and they will never get a bank account. So we're here for that section of society that can only transact in cash. Now, to put some numbers on that, in terms of global remittances, last year $65 billion was remitted in cash. So that's the volume of people that's the volume of transactions for people that don't have any other way to send money home or to pay that bill.
Right. It's still a really significant amount of people. So Santiago, that in mind, how do you see the practicalities of perhaps more digital cashless economies playing out if there's still so many people in the world that do rely on cash and that is their only means of payment? What do you see the practical side of it actually looking like? Yeah,
so I agree. I mean, the last mile problem is essentially the most important because the end user needs to transact and pay their bills domestically in their domestic currency. I guess, digital assets in general or cryptocurrencies is a term that is very generalized. And in reality, when you start to inspect each of the different types, they really focus on different use cases. So I'll try to break it down into maybe a couple of use cases. The first and foremost is, the most popular brand-wise known as like Bitcoin. And the idea there is that it becomes a store of value. Right? It's this idea that because it has a finite amount and it's constrained in its monetary policy, that with respect to fiat currencies, euros, dollars, et cetera, they will not lose their purchasing power. In fact, they will appreciate with supply and demand. So the idea of having a digital currency that's a store of value, particularly in jurisdictions where the monetary governance is poor, and you could have situations that might lead you to hyperinflation or debasement of your local currency, it solves a specific problem, right? For that person, if they happen to have access to the technology, and that's a big if. But if they do happen to have access to the technology, let's say through mobile, and they can purchase Bitcoin, then the idea there is that they would, in a sense, protect their purchasing power at some point. However, that has a lot of caveats, right? That requires that at some point there's an exchange that will facilitate the buying and selling of that digital asset with respect to their local currency. And again, you have this last mile problem of if your primary way of transacting is cash, how do you then take something physical in the physical world and translate it into the digital world? And so you need those touch points, basically what Pipit's talking about. These touch points where people that have no access to these, exchanges can do the KYC, can do the AML, and can be onboarded so that they have the ability to participate in that. I call it like exit or vote of no confidence, right? So Bitcoin is kind of like a vote of no confidence on the local domestic monetary policy. So that's one problem that digital assets can solve for a local market, but it still involves this last mile problem. And then the next type of problems that are being solved are precisely in remittances. So you might have a digital currency that does have fairly liquid markets, right? So there are exchanges in that jurisdiction. There are pairings between that cryptocurrency and the currency in fiat, either through a banking rail or some money transmitter rail. And what happens is that these exchanges provide enough liquidity in the local market that all of a sudden you can use them to send value cross-border. So one example, say in the United States, if I wanted to send a payment to Mexico or to Colombia, which is where my family's from, I would go and use an application that converts my US dollars to a digital asset. And then that digital asset on an exchange, that digital asset would transfer to an exchange in the Colombian market and swap out into Colombian pesos, right? And then there would have to be a touch point for the person receiving the value to cash out into physical cash. Mm-hmm. So digital assets can be used for multiple kinds of functions and solving problems for the unbanked, but they still require that there be infrastructure there available to service them. And that's what most of the effort is right now in the cryptocurrency space, is building out that infrastructure so that people can participate.
Mm-hmm. Mm-hmm. And do you think we're a long way off it being mainstream, or is it something that's developing faster than we can possibly imagine?
I think it's developing fast enough that it's causing concerns with many of the central banks, and they realize that they need to provide a higher level of service. So if anything, at the end of the day, if cryptocurrencies are they themselves not successful, say in being a global currency, at a minimum, they are putting pressure on local sovereigns to improve their systems, right? Make real-time gross settlement possible, make digital money possible. And so central banks are now starting to create what they call central bank digital currencies, which are essentially the sovereign's expression of fiat, but in a digital form. And so in that way, if the citizenry don't have access to banking and they have a mobile phone, and there's some other identity layer associated with them, and that's a key prerequisite, then the central bank can basically issue into existence different policies, right? So for example, with COVID, there was a big need to provide stimulus to, keep people receiving income while they're home in quarantine or to keep the pandemic down. So the central banks are realizing that the traditional banking system is really not that effective at providing the kind of stimulus, and the treasuries as well too on the fiscal side. But they're realizing that the traditional banking system has not been the most effective way of transmitting their policies into the population. And so their intent is to construct CBDCs that use a similar type of technology as cryptocurrencies, more so wallets, right? So rather than thinking of an account and a deposit at a bank, you have these digital wallets that are essentially your address. You're the only one with a key to the wallet. And so if the central bank wants to add some value to that wallet, they can do so without anyone else. And so that's going to, I think, bring up issues around privacy, behavioral economics as they try to change incentives. And so again, cryptocurrencies play a role where if you don't want to participate in that particular governance domestically, you can check out of that system and have the option of buying alternatives that also can store your value or allow you to transact outside of the system.
Yeah, I mean, something that kind of I always understood as kind of one of the main motivations of cryptocurrency was the idea of decentralization. So if you're saying that now with central bank digital currencies that it is centralized, does that defeat the idea of what a cryptocurrency was intended to be? I mean, is that the idea, or should it be that the cryptocurrencies escape that allows you to, leave behind any corruption associated with a central bank or any worries that people might have had about the state controlling the currency in the first place?
I think what it does is kind of consolidates the corruption. So it makes it easier as a citizen to essentially put pressure on, we're all citizens of our countries. And at some point we have to decide whether the governance structure is acceptable or not. And it's not about deciding whether it's good or bad. It's just, is it acceptable? Does it solve a sufficient amount of problems in my daily life that I'm going to continue to tolerate it? Now, when you're dealing with a network of banking institutions that are dispersed, you allow for corruption to be equally dispersed. And it's difficult to, as citizenry, enact enough pressure in the right place for reform. Now, if you centralize that corruption into a central bank, then what we're really saying is that there's now a smaller group of people who have a kind of disproportionate impact on policy. And therefore, if they are corrupt, it will be pretty apparent. And that's kind of where you can focus your pressure as a citizen. Now, all that is very difficult and takes sometimes generations to occur. So instead, you can decide, look, I'm not satisfied with the service that my central bank and my local governance is providing. And now I actually have an alternative. We're all conditioned and born into the world thinking that we are expressing value in a way that's told to us, right? I'm born and I'm told you're going to be using dollars from now until forever. And this is new and different. This is where I'm now born into a choice. And if I don't want to transact in those dollars, then there are people working behind the scenes to create infrastructure where I can either check out of the system or transact in a global way without dollars. And so that's really where I think there's a paradigm shift between CBDCs, which is the same old dollars, fiat currencies, and the same old problems of governance, and decentralized governance, right? Where we as kind of like a community, global community of participants use the market to decide whether a particular governance structure is satisfactory or not, if it's solving a problem for me. And if it's not, there will be others, right? There's more than just Bitcoin. And that's what's so exciting, I think, about the space, is that it creates this choice for humans to express their values.
Mm.
I just had maybe more of an observation than a question for Ollie and Santiago. It seems like when I talk about the digital currency in Africa, of course, it speaks to me as if it speaks really to me and to my generation, and it answers questions of personal trust and trusting the banking system and the governments. And at the same time, Pipit really answers my grandmother and grandfather problem. Do you think like it's creating maybe a gap between the urban and the rural city, and maybe the rich and the poor? How do you see?
I would think Any gap goes back to accessibility, as kind of Santiago said, the start and infrastructure. So, I mean, data connections, internet connections in Africa are expensive once you get outside of the cities. Wi-Fi is very expensive, or 4G. The penetration of phones is almost complete, but the penetration of smartphones is not as high. So I think cash is as old as it gets in terms of money, and cyber or crypto is new as it gets. And I think we're bridging both ends of a problem.
Can I just come in with a question from the audience, please?
Yeah, go for it.
So it's coming back to the question of the environment and energy use and CO2 production for cryptocurrencies. And it's funny enough, it's a point that Santiago, you made the other day when we were talking, all of us together to prepare the event. Could it be argued with some of the modern cryptocurrencies that have perhaps less energy use than Bitcoin, especially if you compare them to the CO2 production from a legacy bank, where you've got, a normal bank, you've got huge office spaces, lots of people working there, particularly in certain African countries where the infrastructure doesn't exist, you'd have to actually build it. So there will be CO2 emissions there. Could you argue that maybe a leapfrog, a bit like we've seen in Kenya with M-Pesa, from no banking system to a modern digital crypto banking system could actually be environmentally beneficial, because the energy use, the total net energy use is actually less for certain types of crypto than it would be for setting up a huge old style banking system like we would have in Europe.
Yeah, absolutely. I mean, net energy use is really about carefully accounting for all of the life cycle costs associated with any process. And in part of that include the externalities. So the externalities being CO2 emissions or impacts on the environment, the conflicts that come about from geopolitics around energy resources. So all those costs, if you carefully itemize them, one could make an argument that a particular class of digital assets would likely be a vast improvement because they're virtualized, right? And when you virtualize something and you provide the same level of service versus a brick and mortar, of course, the cost of providing that service and all those externalities are going to be lower. But you do have to make a very careful accounting, because some of these costs are hidden in places that you might not normally look, right? You still need data centers to provide the cellular signals and towers. You still need computers to process the transactions. So it's definitely an improvement, and I would argue it's a step change improvement. But to be fair, you would really need to look at the entire life cycle and carefully account for everything.
Okay, so we've got another question come through. Before I ask that question, if anybody else has a question and they'd like to send it through to me, then use the message facility on Zoom. Or if you wish, then you can raise your hand and you can ask the question directly yourself. So the next question we had come in is specifically about the cryptocurrency experiment in Ethiopia. Now, as I understand it, and this is the question, it's going to be based in the main city. So what would happen if such a small cryptocurrency was then subject to speculation? Would that mean that the price could fluctuate and therefore it could quite rapidly, and therefore it could damage the credibility of the currency? Because if you're looking to use a currency for everyday transactions and then suddenly it's subject to speculative fluctuations, so I think the question for that is really, what's the optimal size for a cryptocurrency so that it can actually be used as a day-to-day currency?
Yeah, personally, I feel that most cryptocurrencies, Bitcoin included, are not yet at the size that they can be used to facilitate real-world transactions for several reasons. One is at the layer one, or in the network itself, many of them don't have the throughput capable to do the hundreds of thousands of transactions that citizens require for a nation state. it may be achievable for a city to facilitate those transactions. So you take a network like Visa. Visa has many different data centers around spread around the continent that are optimized for things like latency, and they're the ones who make sure that there's no double spend. Remember, we talked about at the beginning of the conversation that someone at the end of the day, whether it's a program or a corporation, a third party, has to make sure that there's no double spend. So Visa can do that by the fact that it's so centralized that it can make sure all those transactions occur and not have a double spend. Now, when you decentralize it in the way that blockchains are architected, there are trade-offs. And one of the trade-offs, unfortunately, is this throughput. So really, when you talk about e-cash or digital money, you really would need to talk about who's providing the service, what's the throughput that you need to provide that service? How many people are you going to service? And then decide what the architecture is going to be of that design. And that's why a lot of central banks have to be centralized, because they're processing trillions of dollars in transactions, not millions of dollars. So I think we're still pretty far off from cryptocurrencies being at scale, a currency like a yen or a dollar or any other currency. Now, there are experiments at a local city level where a currency is digitized. There's a digital expression of it. And the idea there is that it doesn't have a speculative component because it's issued by the sovereign. One peso will always be one peso, whether it's a digital peso or a cash peso. It's still one peso because it's a deposit with the central bank. And so it's very difficult to speculate on that and cause the volatility in the prices that would make it unuseful for day-to-day transactions, right? So I know that if that digital peso, I'm going to use it to buy a gallon of milk or a liter of milk, then I know what there's price clarity there. And it really doesn't matter that it's digital or cash, or that it's in a city versus outside the city, because at the end of the day, it's the sovereign, it's the central bank that's issuing it. Now, if it's somebody else that issues it, then that could be a problem.
So your crypto in Addis Ababa is the same as your paper money in the sticks in the countryside?
Yeah, because it's not really decentralized cryptocurrency. It's centralized digital issuance of the fiat currency, right? And again, it depends on who's the issuer. If it's just an algorithm, it's a set of computers that are processing it, then it is absolutely likely to be volatile, because speculators will assume that it's going to grow in scale, and it's really not money. Versus if it's the banks, the central banks that are issuing it, then there is price certainty, at least in that jurisdiction. Now, how that relates to the volatility or FX of other currencies in other jurisdictions, that's a kind of a different question. I think that's what the Chinese are headed towards.
So I'll address this question to Ollie. It's a question from Lewis Frayne. Money transfers are so easy in the UK and Europe with companies like Revolut and Monzo. Why is it so difficult to send money to Africa? Hopefully, Ollie, you'll be able to say it's not difficult.
It's the same issue as with creating an account. If you can get a Revolut account, it's easy, but you have to have the same ID, proof of address, KYC information to open a Revolut account as you do to open a Barclays account. Yep. The big problem in the UK and Europe when people migrate is the proof of address piece. If you're a recent migrant, you're looking for work, you're generally sharing accommodation, which means that all the bills in the house already have a name on them: the electricity bill, the gas bill. You can't use a mobile phone bill to open a bank account. So it means that people are just stuck in that loop of trying to get a bill in their name that they can open an account. Once you've that done, then you can start using Transfer to, Transfermate, Remitly, all these kind of things. But until then, you're using Western Union or the likes. There was some context. A couple of years ago, I moved to England for a year as part of starting up Pipit, moving from Ireland. So a very easy migration, no visa. Well, back then there was no visa requirements to move to England. A full-time job, spoke the language, etc., etc. And it took me 7 months to get a UK bank account open up. The UK, the housing authorities and rental housing places wouldn't accept my Irish bank account to pay my rent, which meant I had to pay 6 months' rent in advance, which a lot of migrants can't do. Wow. So you're stuck in that loop long term until you can get a bill in your name. So that is the big blockage, I think, in Europe. But like I said, in some areas like the UAE and Saudi, you need to have a specific visa before you can get a bank account.
And the more in Europe and the UK, the more the governments ratchet up the know your customer and due diligence requirements, the more the banks decided it's expensive to take new clients on, and obviously they've got a regulatory obligation to ask people for more ID, so it then becomes even more of a problem. I've got another question that's been sent through, and I'll address this to Ollie again. Do you see physical access as the biggest challenge, or education? This is from Jess Phillips. How do we enable this kind of information of choice to opt out of fiat or penetrate to the general public? So I think Santiago can come in on this as well. What kind of initiatives in your mind would allow exchanges to hit the next billion people as they come online for the first time? So we're talking about what do people need to do, I think, to have access to banking and then also access to cryptocurrencies. Is it a question of them just getting education on the options, information on the options, or is it, as we've just said, for people moving to Europe, is it a question of having other particular problems?
Well, in the UK, there is approximately 1.5 million adults in the UK who are unbanked. About half of them are migrants, and the other half are generally people with learning difficulties or other issues. So the migrant element of it is certainly about proof of ID and being able to prove who they are and passing the KYC. The English element or the British element of unbanked are people who need more support from their local services to be able to get banked and to be able to access the systems. There is the physical element as well, of course, with a lot of ATMs being shut down because the amount of cash being withdrawn is reducing. But there's actions being taken now to stem that by various groups like the post offices, etc. We're trying to make sure that people have access to cash. And we talked about cashless briefly, but the likes of Sweden, which is kind of the front runner of going cashless, are now kind of realizing that we need to put the brakes on this a bit, because if it's a cashless economy, who controls it? Is it the banks who go out of business now and again? Because it kind of moves it from a sovereign central bank control into a PLC control, which isn't. I don't think anybody wants that. And in the US, there's been a lot of examples as well in New York, New Jersey. It's now been legislated that restaurants, shops, cafes have to accept cash because it's seen as discrimination against unbanked people. So the access to physical access is now being protected, which kind of goes back to Alex's question. Maybe it's all happening a bit too fast, and who's driving it and why. It's not for the consumer's benefit, I would think, anyway.
Yeah. So Santiago, access to cryptocurrencies, is it an information question, or is it a technology question, an access question, or both?
I think it's both, but I want to build on Ollie's point a little. I think there is a concerted effort to increase power of central banks to enact monetary policy, and I think that we're seeing that expressed in a lot of different ways with this kind of war on cash. And in the United States, legislation has recently been introduced for ensuring that people have access to banking at like post offices. We don't have that yet today. So it's a real problem. And I think that if you move to purely digital, besides just the power outages and the access, I think the other problem too is that you create systemic risk when everything is digital and the control of one issuer. It could lead to some problems, and of course issues of privacy. And the Chinese central banks are doing this very aggressively at a high pace, where the other thing we haven't talked about is a lot of cryptocurrencies are programmable. And by programmable, it means that I could come out with a policy that says, okay, Ollie's in a higher income class, so his tax bracket is whatever, and George is in the middle income class and he's got a different tax bracket. So when I do a monetary stimulus and I airdrop some digital euros or pounds into their respective wallets, that automatically the tax policy will take an effect depending on who they are. Or it could even be based on their behavior, what their criminal records are or whatever. It increases the probability, I think, of more of a surveillance state where behavioral economics really start playing into how to direct policy, and that's concerning. So we definitely have to guard against that. And I think cash has a unique role. First of all, it's private. That's the most important property of it. It's completely private to some extent. And then, of course, it's fungible, right? You don't need to rely on these other third parties, banks or e-commerce providers, exchanges, anyone. You don't need to rely on them to transact. And that's incredibly powerful. And it would be a shame to see that power taken away from the people that most need it. Now, with respect to your question on exchanges, most exchanges require almost a similar level of KYC to participate. They might allow you a certain amount of transactions without that KYC requirement. So you can buy cryptocurrencies on an exchange without providing your identity, assuming you have some other form of digital money. And so that's a whole separate problem. But again, the standard is still high. There still needs to be a kind of an identity layer that's constructed and an infrastructure around identity to facilitate that. And that's not fully mature. Those standards are not consistent across all jurisdictions. So that's a barrier to adoption. I think until we solve the identity layer clearly, you won't be able to onboard people into the digital assets, cryptocurrencies at scale to get the kind of wide global adoption. But that's where a lot of the work is being done in the industry now, is in establishing and using blockchain technology for identity. So, we'll stand by. We'll see how that turns out.
Okay, so I've got another question that's just come through from Marvin, and I think Pete, Pete Nyamoya, you wanted to ask a question as well. So if I ask Marvin's question first, and then Pete, either I can read the question you sent or you can ask it yourself. Just let me know when we've answered Marvin's question. So Marvin's question is, can you see Africa moving to the adoption of one cryptocurrency that can be used across the whole of Africa, like Acoin in Senegal, which aims to do just that? So that's quite an interesting question for us as well, because one of the subjects we'll be addressing next year is the CFA, so the African or Pan-African currency that works across several different jurisdictions in West Africa. So so do you think there might be a cross-border cryptocurrency like Acoin that could become a standard currency?
Is this directed at me?
To Ollie or Santiago, or both? Sorry.
I'll let Ollie go first.
Thanks. I haven't read much in detail, but I know there was talk of a Euro-style movement across Africa, which maybe Alex might know better. Really, I think it kind of requires more of a political unity, which is probably a bigger problem to solve than a fiscal one across Africa. The CFA is in most of West Africa, so a lot of the countries, Senegal that we deal in, Ivory Coast, use it. So they do have the start of a pan-African currency there. I don't see any reason why that couldn't evolve into a single crypto, but if it's going to be a nationwide one, it then needs some sort of a central bank to issue it. And I think we're a long way from an African central bank.
Yeah, I mean, this gets into a similar problem we've got with the euro already, where you've got a central bank, but several different jurisdictions and sub-central banks issuing bonds, and therefore it's not very clear, monetary and fiscal policy is not very clear, and that's a problem that's fundamental to the project of the European Union and the euro. And yeah, I think we're a long way from that now. But what if it was a bit like the dollar? I mean, at the moment, the dollar is used as an international currency. Could you see that, Santiago? People being confident because one or other nation within Africa had issued perhaps a state-backed digital currency, and then other people in other nations decide that it's more stable and more trustworthy than their own currency, and therefore would start using that?
Yeah, that's a super interesting question. There's so many directions that could go because the technology allows for a lot of combinations, right? You could imagine a digital asset that is a basket of currencies from each representative nation. And in that case, as each central bank enacted their policy for their respective country, it would affect the proportion in that basket, probably inversely, meaning, your purchasing power with this African currency would go down if your local central bank is issuing too much, right? So it would attempt to try to reflect the inflationary aspects of policy or deflationary in some currency that then is interoperable. And that's the key term, is as people would go from one country to another, or as there's trade between countries, that currency would have to be interoperable with their local domestic currencies. And so you're really talking about a network of CBDCs that are kind of being atomically swapped, one for one, real time. So that requires some pretty complicated infrastructure in the back end, as well as what Ollie was talking about, which is this political consensus, right? So cryptocurrencies, for people who aren't familiar with them, they're all about human consensus. They're all about rules of governance that a certain quantity of people decided to abide by. And the technology layer is actually less important than the human governance part. And so I think when you're trying to scale them, all you're really doing is you're scaling those systems of human governance to political governance, right, at the nation state level. So any construction is going to have to consider the politics behind that arrangement and how that would affect their individual power. That one of the main frictions in Europe is this disconnect between local fiscal and the ECB's monetary policies, and that's an unresolved problem in my mind. I don't think we've seen a conclusion to that, and there's no guarantee that it's going to be a successful quote unquote experiment. So. I think that would likely happen in Africa, regardless of the technology that you use underneath.
Yeah, I think it comes back to trust, right back to the start of the conversation again. So I mean, this is what Facebook and Libra tried to help the world out by launching this global currency, and we saw very quickly how few people trust Facebook. And I know they've rebranded it to something else recently, but all their major partners, MasterCard, Visa, pulled out, governments blocked it, et cetera, et cetera. So we're back to the start again. It's all about trust.
Yeah. If I can just add something about the differences between the West and the East, is that I don't know if you heard about this. I think the French ministry is trying to change the way we see the French CFA. In Europe and in France, and the President Macron is trying to do something else. We can believe it or not, but it is what it is. I think the West side government has a way of dealing with their own unity that is so different in East Africa. East Africa, we're about blending in, but we're not looking for one currency, according to the governors of the central banks. And I think that even when we start there, the trust really starts there. When you know that the French government is dealing with your own currency, it is really different, if I may.
Yeah, and I mean, I think the solution to this problem of counterparty risk, which is I think what we're identifying here, whether it's Facebook or sovereign, the solution to counterparty risk is interoperability. It's where I can express value in any way that I want, be it as an individual, a corporation, a government, and the recipient is not forced into accepting those terms, right? And so how does that functionally work? you can, like, for example, let's say I wanted to send Alex a Bitcoin.
They can't see you and they can't hear you.
I'm sorry.
Someone, yeah, because the person switched their microphone off, please. Yeah, it's done. Sorry.
No,
go on.
No, that's okay. Yeah, so I think the ultimate solution to that is where people are currency agnostic, where you can express the value in terms that you want, and then there's our third, there's market facilitators who will basically they facilitate that transaction and ameliorate that counterparty risk, but through code, right? So if I want to send Alex a dollar, but she doesn't want dollars, she wants it in Bitcoin, that there is a code in between of us, in between the two of us, that we can mutually inspect, that it's immutable, it's transparent, and will facilitate that transaction based on market principles, right? That there is some proportion of the dollars to Bitcoin that the market currently agrees on. And so we could facilitate the transfer of value real time, and that might change. The problem is that fiat is supposed to, fiat currencies are supposed to represent certainty into the future over your purchasing power, right? You hope that when you get paid in this pay period, that you'll have enough money to pay your rent at the end of the month, assuming your rent didn't go up. So when you have monetary policy that affects your purchasing power, it creates uncertainty with respect to your currency on how you'll be able to pay your debts. And so at the end of the day, all currencies, digital, crypto, decentralized or centralized, have to be liquid and stable enough to have certainty into the future as to their purchasing power.
Mm-hmm. Mm-hmm.
So Ollie's got another meeting now, so I'm going to let Ollie go, but we do have another couple of questions. So if Santiago, you'd be able to stay with us.
Thank you, everyone.
The last couple of questions, which particularly relate to digital and crypto. And thank you ever so much, Ollie, for joining us. That's been great to hear from you again. So yeah, I've got a question from Kenneth here. Sorry, I'm just going to run through it. Okay. So Kenneth asks, what does it take for Bitcoin to switch to proof of stake or any alternative double spend validation? So yeah, I'll let you take the question.
So historically, Bitcoin, among other cryptocurrencies, have what they call forked. And that's where the code base that underpins their operation has changed in some way. And as I said earlier, these digital assets are expressions of community, of consensus, that we're all going to agree on the rules of governance. And what happens is when one segment of that community reaches a critical mass that does not agree with another segment, you get these forks. And there's different rules of governance that the new community is going to go, and those forks carry with them a new name. So you might have Bitcoin as the original, and the fork might be called Bitcoin Cash, and they'll have different properties. The rules of governance have changed. So what the question refers to is, could you imagine a situation where the rules of governance change away from proof of work, which is a type of consensus algorithm, to proof of stake, which is another kind of consensus algorithm that's significantly less energy intensive? To be honest, I think for Bitcoin, that's highly unlikely at the moment, only because the community that's presently vested in it is pretty unified in its properties, and is unlikely in the near future anyway, to decide to fork into a new ecosystem. Now, I think as more people enter into the community, more perspectives are going to be added to that, and there will be pressure that will mount to change some of the monetary policies, which are very restrictive in terms of, like, for example, total supply. So I do see in the mid or long term the possibility that any consensus-based system, any cryptocurrency, can fork and change, and I would put Bitcoin under that category.
Mm-hmm. Mm-hmm.
Okay, so
sorry, can I just turn my mic on? You ask another question?
Yeah, please do. And we'll have one more question because a couple of people like Alex, for example, need to go in about 10 minutes. So yeah, go for it, Kenneth.
Sure. So in order for Bitcoin to choose their consensus mechanism, they would have to fork. and change their name, or can it all happen on the current network?
Yeah, so that's a great question, and we have precedent in the past on that exact behavior. Typically, the dominant, let's imagine that you have a community. It's 100%, and 70% decide they want to keep the old rules of governance, and 30% decide they want to try something new with some change. Likely, the 70% community, which is the dominant, will retain the brand. Right, they'll be what's called Bitcoin moving forward, and then the 30% will have some new name associated with it, a new symbol, and the rules will be different. Now, along with that come all of the participants. That's the exchanges that help people buy and sell it. That's the miners. They call them miners. These are the computers that do the proof of work hashing. They have to agree because sometimes their equipment can't support the new fork. So there's a lot of considerations regarding how all these participants decide to go with either the new proposed path or the old path. And that's really more about branding and how the majority decide to call each of those paths.
Mm-hmm.
Okay, thanks very much, Kenneth, for that question. So I'm just going to ask a last question, and then I'll hand over to George, who's got some information to give you around our social media. So the last question is, drawing on from what Alex mentioned earlier, could the introduction or extension of cryptocurrencies into African nations lead to greater division between rich and the poor? And it's a question that we've already asked in some ways. How can rural areas catch up on technology with the cities? And could there be an adverse effect on equality?
Wow, good question. I think that, well, first of all, access, if somehow the poor in these jurisdictions manage to gain access to purchasing cryptocurrencies, they may actually have a leg up on incumbent wealth, simply because let's say they buy a Bitcoin locally or some fraction of a Bitcoin, whatever they can afford. There's a global path of liquidity that's being introduced into Bitcoin. So there are Europeans, there are Americans, there are Canadians, Japanese, they're all buying Bitcoin. So it basically acts as a conduit for the liquidity that's coming in globally to them as a holder locally. And so in that sense, if they're savvy enough, technically speaking, to actually buy it, they'll have a leg up on somebody who's wealthy in local terms, right? Their jurisdictional purchasing power, because maybe they own a business or they're politically connected, whatever it is that defines them as wealthy locally, the owner of the Bitcoin could outpace the wealthy person. And so that in that case, it could ameliorate some of the inequality. That being said, it's more likely that the local wealthy would be concerned with the monetary policies of their central bank in terms of diminishing their purchasing power, and they themselves would be buying Bitcoin. And so really it would act more of an accelerant for their wealth, and it could make inequality worse. So it's really about access and who's going to get the opportunity, but at least there's kind of a level playing field where both the poor person and the wealthy person can buy it. But again, it goes back to access and the ability to have that rail where you can either use cash or digital money to buy into those digital assets. I hope that answered
it's kind of an existing question anyway with the dollar or other assets. If somebody in an urban area has easier access to dollars, then they can get hold of an asset which is perhaps more secure than the local currency. So I think it's an issue that already exists. So thank you ever so much. That was Peter Naya who asked that question. Thanks for that question. It's a great question. So I'm going to just say thank you ever so much to Alex. She's got another meeting, so she's got to go now. Thanks very much for participating.
You're
First
welcome.
of many events. We're obviously looking at different country events for Africa. So we're going to do some events next year on different African countries, and also events on CFA currency, which yourself and George are preparing already. So I think that's going to be great. I think it's going to be interesting. Thanks ever so much. And I'll
Thank you very much.
Take care.
Thank you.
Thank
No,
you.
thank you, Alex, for co-hosting with me today, and thank you also to the rest of the team. So Ian and Adam and Maiwen, because there's a lot of work that goes on behind the scenes. But massive thank you to Santiago, because it's always great speaking to you. You've always got brilliant insights, and thank you to Ollie, who has already left. And thank you to our sponsors and promoters, so Sancheng Digital and the Toulouse Business Exchange. I hope you have all enjoyed it. If you're watching on YouTube, please give us a like, leave a comment, and subscribe to our channel. And please, everyone, follow us on social media. So we're on Instagram, Facebook, Twitter, and LinkedIn. And all of the links will be available on all of our platforms and YouTube channel. So please share future events with friends, family, colleagues, anyone. And we look forward to welcoming you all again to the next event, which will take place on the 11th of February, and will be on the green economy, focusing on electric vehicles and energy. So thank you all, and wherever you are, have a great day and have a great Christmas.